Hello, everyone. Welcome back to the G360 podcast. Today is the first series of our podcast, the Generational Investing segment. Today, I'm joined by our Chief Investment Officer, Steve Kolano. Steve, how are you?
I'm doing great, man. Thank you. Thank you for having me on. I'm not usually invited to too many places, so I'm excited to be invited anywhere, but psyched to be on. Thanks for having me.
Well, we are happy to have you. Today, the focus is sort of to discuss our investment thesis, how we deal with investments, how we integrate with your team and leverage your team and your exposure to help our clients in building what we believe is the perfect portfolio and really gain access to some unique investments. At Generation Capital Advisors, we believe that the best portfolios aren't complicated. They're clear, disciplined, and designed to last for generations. So I want to talk a little bit to start about where you came from and learn a little bit more about your backstory and why you moved into the wealth management space.
Yeah. It has been, coming up on, scarily enough, it's been about coming up on almost 30 years, scarily enough. It is, I'll say financial services is the only industry I've ever worked in, and got into financial services way back when, former college athlete, played football in college. And so kind of that competitive spirit, I guess, was in.
Yeah.
And so as a result of that, one of my oldest brother, I'm the youngest of five. So my oldest brother was a former athlete as well. He's an advisor, and he's coming out. He's like, hey, headed like former athlete, head sales and trading on Wall Street. Like it's like being in the locker room before the game. And to be honest, I was like, kind of take your siblings' advice. I'm like, oh, okay, sounds good. And so was able to land a spot. I started off, cut my teeth, so to speak, on Wall Street in New York. I was trading. I was a junior trader for JP Morgan, trading European ADRs. So back in the day, we'd do the conversion between locals and ADRs and the currency, et cetera. And kind of did that for a couple of years. And then as a trader, I was eager to move back to Boston, where I hail from, Boston born and raised, so to speak, kept trading. But what was interesting is as I was a trader, started to see stocks move up and down, and I could trade them, supply and demand, but started to become more curious in terms of like fundamentally what makes stocks move. And so, as so many successful past people take, it's like follow your curiosity, So I got the opportunity as a junior analyst on a small cap equities team, and at that time started doing CFA, et cetera, and understanding that. And then again, curiosity, maybe curiosity kills the cat, hopefully not, but started to become really curious in other asset classes. Like, all right, there's equities, but oh man, there's fixed income, there's commodities, there's currencies, portfolio construction. Like it all started to become fascinating to me. But more than anything else, like the markets themselves became just a fascinating beast in of themselves. I compare it, like if you ask me at the end of the day, like, there's a great documentary on Tom Brady. He used to be able to just sit and watch game film, and he was like zen for him. I could sit in front of my Bloomberg, and it's just zen for me, watching the numbers and across asset classes. And that's the markets for me. I always say, like, in sophomore year in high school, I read, Catcher in the Rye, and to so many people that, it's just like, hey, it's words on a page. But I saw like the symbolism beneath, those words on a page were just always fascinated me. To me, the markets are the same thing. It's like, to so many people, it's numbers blinking up and down on the screen, but it's like, oh, wait, like this morning, it's like, oh, the 30 years back through, 5.1. And that's a result of the fiscal policy tax package that got passed. Like the movements behind the numbers are fascinating to me. And so when you put that all together, I started to do a lot of work with institutional clients, in the multi-asset space earlier in my career. And then if you just look at, I always say follow the responsibility for retirement, and you will follow the money in this industry. And what's evolved over the last couple of decades, like if you think about pensions are getting fewer and fewer now, the 401k, the 403b, the HSA, it's really into the on the eyes of the individual to kind of to provide for themselves in the future. And that growth and that fascination kind of took me in from the institutional space into the wealth management space. And then add to that, just people have always fascinated me. Everybody has a backstory. Everybody has previous experiences that form their outlooks on the future. In a lot of ways, that rhymes with that's always rhymed with like my market view of like, you let me nerd out for a second, like markets exhibit characteristics of complex adaptive systems, right? Markets are systems, and but they're all built off of past experiences. So it all kind of rhymed. And so it all, for me, individuals and the markets and multi-asset all kind of came together in the wealth management space, and have been here now for, probably coming up on 6 or 7 years. And it's been a ride.
I love it. Yeah, you've been an integral part of our team now. Can you talk a little bit about how you work with advisors like Sam and myself and Generation Capital advisors at large in order to build our portfolios and to be that due diligence resource that we need?
Yeah, totally. So in my role now as Chief Investment Officer, I'm responsible for the investment platform of integrated partners. And as part of that investment platform, like all our advisor teams, Generation Capital in particular in this case, but all our advisors and their advisor teams, they have the ability to choose to work with the investment team of integrated partners. So today, we stand at about 40 people between, trading, portfolio management, operations, and whatnot. And so our mission statement, as I've said, is our mission statement is to earn the right to be our advisor's investment partner of choice. And so that keeps us on our game, right? Making sure that, to your point, we have the due diligence resources that we need, we have the academic resources that we need, market strategy, you name it. And then from there, it's as that part of that mission statement, hopefully advisors reach out and like, hey, listen, you're a trusted partner. We're all aligned in the same goal between clients and success of helping people achieve their goals. And from there, it's just engaging with each individual advisor team. And similar to working with individuals, it's like, okay, what makes your team unique? What's your value proposition? What makes you tick? What's your DNA? Really tapping into that, and then helping that advisor team or advisor kind of take that same DNA and make sure it's applied to the portfolios. And that comes through. At the same time, overlaying what I'll say is good, prudent kind of investment principles as foundational, thoughts or foundational beliefs, if you will. Hey, good global diversification. To your point, asset class exposure, good betas, and it does not have to be complex to be successful. Like Occam's razor, right? Usually, the simplest answer is the best approach. So, try to bring that all together into portfolios that kind of attach with the DNA of each advisor.
Yeah, I love that specifically. When we think about the DNA of Generation Capital Advisors, how we build portfolios, right? Our core philosophy is that simplification is the ultimate form of sophistication. And what we mean by that is we are big believers in American exceptionalism, and we want to be the market, not beat the market. Right? We often see a lot of people that get caught by the investments that try to beat the market. They had a ton of complexity and they have X, Y, and Z active manager. And in the end, our whole goal is that we want to simplify portfolios, reduce cost, and be the market. We want to have long-term beta-driven analysis where if we own the market and we diversify across market sectors, we believe that that's how we're going to build the best portfolios.
Couldn't agree more.
Can you talk about, your thought process as Chief Investment Officer in terms of, are you a big believer of beta at large and sort of long-term buy and hold approaches?
Oh, again, almost 30 years, you guys hear me say this all the time. I'm like, listen, at the end of the day, economies grow, the US economy grows. And with that, market capitalizations increase over time. And I'm, one of the seminal kind of articles that kind of set a lot of my investment oversights or kind of perspectives. Gary Brinson, right? The famous portfolio determinants of portfolio performance, and huge academic study, actually looking at institutional portfolios in this case, but seminal article or seminal white paper on just if you look at the determinants of portfolio variability and ultimately connected to that determinants of portfolio performance, it's not like Coke versus Pepsi. It's asset allocation, stock versus bond, asset allocation, and then connected to that, what your exposures are, connected to your risk tolerance, obviously. But then from there, it's just economies tend to grow over time. And then underneath that is this and if there's ever a period that proves this, it's you cannot time the market. Have a good financial plan, get market exposure, let economies do what economies do, they grow. And with that, capital appreciation happens. And you can't time it. And I mean, this year, holy smokes, if there's ever a period of time that shows that. But yeah, I'm a firm believer in keep it simple, be efficient.
Yeah. So, I guess my question is, we tend to focus a lot on our alpha being driven from the planning side of things, on how do we save more money in taxes and how do we strategically allocate the portfolio as opposed to trying to beat the market or generate investment alpha. I would say that's our core belief. But why do you think so many firms and so many advisors do still chase that complexity and do still try to beat the market over time? When, if you look at history and you look at the data, it's extremely hard to beat the benchmark. Why do they still chase complexity?
It is a good question. Why did Ponce de Leon search for the fountain of youth for so long? Right. You make a good point. To be honest, I don't know why so many people search for, try to outperform the market for so long, and they spend so much energy doing it, because there's an important ingredient or important aspect of alpha that is mathematically true. Like, alpha is a zero sum game. So, like, unlike beta, that like beta market capitalization, just it grows, right? So that is, the trend is your friend when you're looking at beta. Alpha is a zero sum game. If somebody's outperforming, somebody else is underperforming. And I think that lends itself to, again, not trying to time markets. To try to time alpha is even more difficult than trying to time a market, and both are I won't say fool's errands, but they are extremely difficult to do. And then when you add to that just letting time work on your side, just be in the market instead of time in the market as opposed to timing the market.
Absolutely.
The simplicity of beta, let it do its thing. And you make a really great point on, I have been humbled at, being the investment person. A lot of times I'm like, hey, listen, investments are a commodity, and ETFs have helped accelerate that commoditization process. But when you put those commodities together in kind of a unique combination and fashion on behalf of an individual or a family or a couple, what have you, they become anything but a commodity. And it speaks to the humility that I've learned in seeing the power of a good financial plan. And you mentioned estate planning. I mean, I've been in several meetings where, through good tax mitigation strategies, somebody's able to save literally 7 figures, 2 commas in terms of taxes. And I usually break into that point and be like, listen, there's not an investment on this planet that I can put in front of you right now or talk about where if you just sign your name, you're going to make or save millions of dollars. It's like, why, don't try to fight it. Just have a good plan in place and let planning be your friend.
Absolutely. Yeah. Our core goal here of any new client that comes in is we start planning first, right? How do we see where we can develop alpha from a planning side of things by saving money in taxes, by protecting their family from estate tax? And then how do we build a portfolio that reduces costs, reduces complexity? So I want to focus a little bit about our methodology and our investment thesis. Our whole ideology here is what we call core and explore. The core being, we want the foundation of our portfolio to be a balanced, diversified index investment approach. And the explore segment is where we do look for those higher octane investments, right? We might search on the alternative side of things in the private equity or private credit market. Or from a tax advantage strategy, we might look to implement something like a long short direct indexing or a long only direct indexing strategy. And if we can surround the core foundation with these other investments that either have uncorrelation to those equity markets or provide tax benefits, we believe that's how we build the perfect portfolio. And it's just a matter of having tools in our quiver and going back to the financial plan to determine what each family we work with is looking for, what their long-term goals are, and how we work with you and your team to develop a portfolio that will help them meet those goals. So when we think about the explore side of our investments, there's a lot of talk in the alternatives and private market space. From your perspective, is there anything we should look out for or be nervous or careful about from the private market segment? It seems like everyone now has an evergreen fund. Everyone now has a private credit fund. When you think, let's segment out to just private credit to start, is there anything in the credit space that we should be worried about or that we should look back at history and have a cognitive eye for?
Yeah, well, interesting. You bring up history. And I think this question actually, I think, touches on the previous one around like the seek for alpha, because if you look at the structural changes that we've seen in capital markets, not only in the US, but even globally, right? the number of publicly listed companies in the United States is less than half of what it was in the year 2000. I think in the year 2000, there was, call it like 8,700 publicly listed companies on exchanges. Today, that number is less than 3,500. If you think about the evolution of companies going private, companies staying private longer, given regulatory pressures to become public companies, Sarbanes-Oxley, et cetera. So you're seeing that decrease in the number of public companies. So it lends itself to just kind of keeping it simple. At the same time, right, the number of private companies in the United States is through the roof. And so that presents areas of opportunity and potential areas of inefficiency that can be then extrapolated for returns. In terms of historical evolutions, I'm a big fan of kind of market history. And I think private credit's an interesting one to raise, because what you have to look at is how markets adapt and kind of how markets adapt in relation to human behavior. And so if you think about COVID, right, you think about not only the 30-year decline that we've seen in interest rates, or had seen in interest rates, I should say, but then think about COVID and interest rates really collapsed. Like the cost of capital was like zero. And so you saw this massive increase in debt issuance, which makes sense, right? Oh, it's like I can get a 30-year mortgage below 3%. Everybody locks in. So you saw kind of a herding behavior for good reason, given the cost of capital. And so now we've seen very quickly, interest rates are now up, 400 or 500 basis points from when they were in depth of COVID. And so now looking at like, okay, there's a lot of debt that's been issued. Economic conditions have changed, right? We're now in a higher interest rate environment. The U.S. economy, while stable, is kind of decelerating a little bit, given the restrictive policy we're seeing. And so now, really being with in the case of private credit, who are the private credit managers that have really done the due diligence on the deals and the loans, if they're doing direct loans or whatnot, that the underlying fundamental can maintain its interest rate coverage through time. So a lot of times when I'm talking to private credit managers, it's like, okay, when were a majority of these loans issued? Was it pre-COVID or post-COVID, right? So it's like if you have a lot of refinancing yet to come from a cost of capital of 0 or a 1 to now 4 or 5 or 6 or 7, okay, what does that interest coverage look like? We have not seen defaults start to pick up yet, but that's probably the biggest area of concern of like, what does the default cycle look like as we move forward? And then to that, who are the managers that have really stress tested the loans that they're making in the private credit space?
Yeah, absolutely. I think Sam and I have been looking, especially in the private space, for quite some time now. And it's, we take the manager selection portion very seriously. And there are some equations that we look for, especially in the private credit or corporate lending space, right? We want low leverage. We want high diversification. One of the funds that we specifically like is the Cliffwater Corporate Lending Index, because no one specific position makes up more than 1% of the portfolio at large, right? So if we do see those credit events, how much of those credit defaults going to affect the overall NAV at large? Those are the things from an advisor's perspective that we look for and we look out for when selecting managers, because like I said, there's, almost everyone has a new evergreen fund or a new BDC out there. And it's just important to ask the question, especially, if you're a client, what's in this portfolio, right? Why should I buy it? Why should I pay this manager 1 or 2% management fee to own this fund? And it's important for you to ask those questions. I want to switch a little bit towards the private equity side of things now. Where do you see private equity adding in terms of, they're a little bit more of a sexy investment, a more high octane investment that have, historically had good returns, but it can get caught a little bit into the weeds. We had a conversation last week about the drawdown funds and how, you're locked in those funds, you're locked in from anywhere from 7 to 12 years. Specifically now you're in an environment where a lot of those underlying positions are having trouble having the exit, right? So they're spreading out the duration, and what was that J curve that may have been a 5 or 6 year J curve might be extending out a little bit more. What are you seeing right now in the private equity space of what's actually going on under the hood, and how do you anticipate that to affect how investors subscribe to these funds and ultimately what their return profile will look like?
Yeah, if private credit is an interesting space in terms of what we discussed, private equity is even more so, because interestingly enough, the interest rate reset that we've seen in the last couple of years, I'd say private equity returns going forward are going to be much harder to come by. And it doesn't mean that necessarily be lower, but a lot of private equity managers are able to generate pretty good returns through the benefit of leverage, right? When interest rates are coming down, leverage is your best friend. And so it speaks to why the point you make around distributions kind of starting to slow down and extensions starting to extend out. A big game that was happening in the private equity space over the last couple of years, or maybe even longer, last 10 or 15 years, private equity manager would make investments in whatever, several companies, sectors, what have you. And the game was, instead of like true long-term investment, understand the value, add value to the company, it was like, hey, let's strip it of its costs, lever it up, generate free cash flow. And then because interest rates kept coming down, what started to happen was it almost became like one private equity company would sell those companies early to another private equity company who was able to then even lever it up even more because interest rates kept coming down. That was actually providing almost like a false layer of liquidity because the exits were happening sooner than you would expect. And so it's like, oh, this is great. Distributions are happening right on time. Now what you're starting to see happen with the interest rate reset is, right, that game of private equity manager selling to private equity manager, selling to private equity manager, that game's up. And so now private equity managers are actually good. I'll say that, emphasize, good, true private equity managers are now being forced in a good way to go back to their roots and be like, listen, we can add value to this underlying company's operations, efficiency, et cetera, even outside of just the use of leverage. But you got to be a long-term investor. And so that's why that's preventing the quick exit to another private equity company, because they need to hold those investments to fruition, which is why you're starting to see extensions on the private equity side, distributions start to slow down. In some cases, extensions, from 10 to 15 years, to your point, because that artificial source of liquidity just isn't there anymore.
Right.
They're having to hold those companies' investors. So it's an interesting time, and it again speaks to wanting to be with the right private equity manager. Like if you look at, everybody talks about the average return in private equity. If you look at the dispersion of returns in private equity between top performing managers, and it is massive. And it's like, you want to be with the right manager, which requires the right amount of due diligence.
Absolutely. Yeah, we're very keen to that, and it feels like we're being pitched a new fund every single day.
But I think we are.
I kind of want to tap into, the beautiful thing about being a part of Integrated is that we're at a firm that is now well north of 20 billion in assets. And with that, it comes a big responsibility to you and your team. But more importantly, it allows us access to some unique investments, being a larger firm that we are now. Can you talk a little bit about, how we can leverage your team to do that due diligence process and to seek out those unique opportunities?
Yeah, absolutely. So to your point, sometimes size and scale makes a big difference. And in this case, we're exactly that. So Integrated Partners now north of actually 22 billion in terms of assets under advisement. So that allows us to be able to work with subject matter experts in specific areas. In addition to the 40-person team we have, right? We work with, in particular, one or two subject matter experts from institutional due diligence resources, right? So we partner with one or two firms in that regard who all they do is due diligence, all alternatives, all private equity manager, private credit managers, et cetera. They have, armies of resources that just focus on that. In addition to that, given their institutional heritage, the access that they can provide to not only Integrated, but Integrated's clients and our advisors and our prospects, right? That institutional access to, when we talk about the dispersion of returns amongst managers, you want to be with the top performing managers. A lot of those top performing managers are closed. They have very limited access. So when you talk about these massive evergreen funds in whatever, private equity, private credit that are coming, you really have to ask yourself, like, okay, like if you're a top tier manager, why are you just, why is the fund so huge and you're seeking capital? Because a lot of times the best ones are closed or the access is limited. Through our partnership and through our size and scale, we're able to get our clients access to those top performing managers that have been covered by significant diligence, who are seeing the best deals and opportunities themselves, right? And that rolls up into take advantage of a more inefficient part of the market, like private markets, to provide those higher octane return opportunities.
Yeah, absolutely. I often, there's an old quote that there's too many assets now chasing too few great firms to buy out. And so I just think it goes to show that it's important for you as investors, whether you're a current client, a prospect, or a client of another firm, to be educated on the manager that you own, why you own what you own, and really what's the goal and what's the outcome, and ultimately what are the risks, right? Where could things go wrong? And is my financial plan and is my portfolio set up that if one or two of those investments do go wrong, are you still going to be okay? Or is it going to derail your entire plan? So totally. I just think manager selection is extremely important. It's important to work with your advisor and make sure that you're doing proper due diligence, and having a team like Steve's on our side to help us sift through the thousands of funds that come across our desk every day is invaluable. With that being said, I hope today that you learned a little bit more about Generation Capital Advisors' thesis. Our goal is to simplify investments, to be the market, not beat the market, and really focus on plan-driven execution to drive alpha. If you're sitting here and questions popped up where it feels like, is my portfolio too complex? Or, how should I do a health check on my portfolio? Sam, myself, Steve, we are happy to sit in front of you and to determine and do a quick health check on your portfolio, see if there's any opportunities that you might be leaving on the table, and ultimately finding a partner to help make sure that your portfolio is well structured to last for generations to come. With that, Steve, it was a pleasure. Thank you very much for giving us our time, your effort, and the team behind you. We love working with you every day, and we look forward to it in the future. This is the G360 podcast. Thank you, and we'll talk to you soon.
Thanks, Rex.
Thanks for listening to the G360 Wealth Podcast. If today's episode gave you something to think about or act on, share it with someone who might need it. Don't forget to hit subscribe so you're always in the loop. If you want to learn more about how we help families like yours simplify and grow their wealth, visit us at generationcapitaladvisors.com. Until next time, take care and keep building. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of Generation Capital Advisors. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Investment advice offered through Integrated Partners, doing business as Generation Capital Advisors, a registered investment advisor. The information in this material is for general information only and is not intended to provide specific advice or recommendation for any individual. Integrated Partners does not provide legal, tax, or mortgage advice or services. Please consult your legal or tax advisor regarding your specific situation. All investing involves risk, including loss of principal. No strategy assures success or protects against loss.